Well, I am back from my summer vacation and I have resumed the mantle here at the SchiffGold Friday market wrap. And so I'm going to wrap up the week in gold and silver today. It was a pretty quiet week for the precious metals. Gold itself was actually down about 0.5%. I think it settled at around 3,336. Silver went the other direction. It actually rose a tad, up about 1/3%, and we closed the week above $38 an ounce. But from a technical perspective, I think the markets are set up for another explosive rally. And what really makes me optimistic now is the action that I am witnessing in the mining stocks. Because one of the problems with this rally for many, many years has been the failure of the mining stocks to confirm the continuous breakouts to new highs in gold and silver. And a lot of people who might have got into the market were discouraged by the lack of confirmation from the gold stocks because people think that gold stock investors, are sophisticated and forward-looking. Because when you're buying stock in a gold company, you're buying into an earnings stream. And so what's more important than the price of gold today is the price of gold tomorrow or, years from tomorrow. Because investors are looking into the future and they're discounting all that income into the present. And the problem was, as investors, particularly on Wall Street, watched the gold market rise, they really didn't understand why it was going up. And they just expected that, well, it's going to go down, that this is just a short-term thing. They found all sorts of reasons to attribute as to why the price of gold was going up. And so they just assumed that it was going to go down. And so they didn't want to buy gold stocks because if you think the price of gold is going to go down in the future, well, that means the mining company profits are going to go down, especially with costs going up. It gets more expensive to mine gold every year. So if the price of gold doesn't go up, it's hard to maintain your earnings. And if the price of gold goes down in the face of rising costs, that's a double whammy. And so the investors were staying away from gold stocks because they were very suspicious of the rally. Well, looking at the action this week, and even in recent weeks, I'm starting to see investors gaining some confidence in this bull market because I'm seeing days now where the price of gold is down quite a bit and these gold stocks are up. They used to get killed. I mean, every time gold went down, they got destroyed. And then gold would make a new high, but the stocks wouldn't make a new high because they got beat up so much on a small dip. But now, instead of being dragged up by the metal, gold stocks are starting to lead with both the GDX and the GDXJ making 52-week highs on the week. In fact, the GDXJ, which made a new high after the GDX, made a new high this week and made a new high today on Friday. And both of those indexes are now up 65% on the year. That is a big move. Gold itself is only up about 25%. So finally, after years of lagging, they're now starting to outperform. And this is a bullish sign because now we've got confidence in this bull market. Now, some people might say, well, isn't that a contrarian indicator now that people are buying these stocks? Not really, because this is sophisticated money. The public is not involved. And it's not like this is a mania, a blowout stage where you go to the supermarket and the cashiers are talking about the penny gold stock that they just bought. The public is not involved in this market. This is more sophisticated money finally moving in. And the way I noticed that is a lot of these gold stocks, when they report their earnings, recently, every time they reported earnings, even if they beat numbers, they killed the stocks. And if they missed numbers, they destroyed the stocks. Well, a lot of companies have come out with earnings over the last couple of weeks. Some of them beat, some of them have missed, but even the misses were great earnings because, compared to what they earned the prior year. But what I've noticed is every time these stocks get sold off, almost reflexively on these earnings, they bounce right back. It might not be the same day, maybe the next day, next 2 days, but they recover everything and move higher. So you have big money now that is buying the dips in these stocks. And this is just the beginning of a huge wave. In fact, that's why, if you remember back in April, I kind of angered some of my reps, my precious metal specialists over at SchiffGold, because I put out a special report from Europe Pacific Asset Management, and it was called The Best Way to Buy Gold. And I was saying, hey, don't buy gold right now. Buy gold stocks, because they were so cheap, and they're still cheap. Not as cheap as they were then, but still very cheap. I wasn't telling people not to buy gold. I was telling people to buy gold in the ground before it's dug up, because when you invest in a gold mining stock, you're buying the gold that's just still in the ground. When you go to SchiffGold, you're buying the gold that's already been mined and fabricated and made into a nice, pretty coin or a bar, right? And you're buying that. And what I was saying with that report is, you know what? Gold's over $3,000 an ounce, and look how cheap these mining stocks are. You got to buy these mining stocks right now. This is not the time to buy gold when these stocks are so cheap. And since I put out that report, the price of gold is only up by about 1%, but these gold stocks are up by more than 20%. Now, they were up quite a bit before I put out the report, but gold was going up a lot. And I thought it was ridiculous that gold made such a big move and the gold stocks were still so cheap. So now gold's kind of gone sideways for a few months, and the gold stocks have taken, the baton and run with it. And so I think this is, a marathon. I think we got a long way to go, but it's a very, very positive sign for the metals. And silver, too. I mean, silver has been demonstrating some relative strength. So I'm not telling people now, hey, don't buy any gold and silver. Everybody should still own some physical gold and silver. But I also think that more aggressive investors should buy these gold mining stocks, because I think they're going to outperform now for many, many years. So if you really want to leverage up your portfolio, don't just own physical gold and silver. Have some of the miners. We manage a fund at Europe Pacific Asset Management, the Europe Pacific Gold Fund. EPGIX is the symbol, the no-load symbol. So you could buy that at any discount brokerage firm, or you can go to Europac.com, talk to the representatives over there. You can buy directly on our website. And silver, I think silver is getting ready to explode. We did get as high as 39.5, I think, while I was on vacation. So we've got a little bit of a psychological barrier up there, close to 40. But I think once we really clear $40 an ounce on silver, it's going to make a beeline for 50. And there may be, and there probably will be rather, a little resistance around 50, because that's a massive double top going back to 1980 and 2011. But once we take that out, I think it's going to explode higher. And I think we'll be headed towards $100 an ounce in silver. Of course, gold's going to be 4,000 by then, but that still means you get a better bang for your buck in silver. So I think the entry point is perfect. I think if you don't have enough gold or silver, call SchiffGold. In fact, we just redid our whole website, and we have a whole new shopping cart. Remember, we introduced that shopping cart, I forget, 6 months or year ago, but now we've totally redone it. It's much more user-friendly. It's much more automated. Just to try it out, you should go on there and buy yourself some silver just to experience it. But you could go over the weekend. It's 24/7. You could just go in there and you could buy, your gold and silver. You don't have to speak to anybody. Not that, we're happy to talk to you. I got plenty of reps that'll walk you through the process. But you can do it all yourself. You could buy some gold coins. You could buy some silver rounds or whatever, silver bars, and load up your cart. Check out. It's a very smooth process. In fact, I would encourage people not to wait, until Monday. Go over the weekend before. Who knows what's going to happen on Sunday night? Anything could blow up. I think these metals are like, the proverbial a coiled spring, and they could really go. But if you want to get into the mining stocks, if you want to get into my gold fund, you got to wait till Monday to do that. You can't buy that over the weekend, but you could buy the physical through SchiffGold 24/7. And by the way, today I don't like to say anniversary. It's been 54 years since Nixon took us off the gold standard. It was August 15th, 1971. And I did a special video. Was it in 2021 on the 50-year anniversary? I did a special video. And in that video, I just, went back to 1971, what Nixon did, and then what has happened since. And it's a great video. It's about 12 or 13 minutes long. So if you haven't watched it, look out for it. I just put it on my Twitter account earlier today, so it's at the top of my feed. It may not be there by the time you watch this, but you can scroll down. But it's The Day the Dollar Died is the title. You can also search it. It's on my YouTube channel, so you can search it on YouTube, The Day the Dollar Died. But it's interesting that you can see the national debt clock on that video. And just since then, in the 4 years exactly since I made that video, the national debt is up by $9 trillion. And the price of gold is up by 85% in those 4 years. Now, of course, if you want to go back to 1971, I mean, the national debt was tiny. I mean, it's like, it wasn't even it didn't even get to $1 trillion until 1980. So I don't remember what it was back then. Maybe it was a couple $100 billion, right? And now it's, 37.5 trillion. But gold, since Nixon took us off the gold standard, and when he did that, gold was $42.22 an ounce after two devaluations from 35. Gold is up 8,000% since then. 8,000%. Now, it's really not gold going up, right? Because gold's the same, right? Gold, an ounce of gold hasn't changed. It's exactly the same as it was 54 years ago. A lot of other things have changed. A lot of other things have improved. Some things have gotten worse, depending on, what you're looking at. But gold hasn't changed. It never changes. It's eternal. It's exactly the same. What's happened is the dollar's value has collapsed, and it's lost almost all of its 1971 purchasing power. I mean, it retains a fraction of it, right? But it's lost most of it. And, if you go back to 1971, prior to that, 1968, they had hearings on taking the U.S. off the gold standard, removing the gold backing. And my father, Irwin Schiff, is one of the few people that testified against it. The chairman of the Federal Reserve, the secretary of the Treasury, right? Those guys were all in favor of getting off the gold standard. And they actually said that gold was weighing the dollar down. And if we freed the dollar from gold, the dollar would gain value and gold would go down from $35 an ounce. My father said the opposite, that gold would go up if we left the gold standard. And of course, it went from 35 to 850 in 1980. So just as they are today, the Secretary of the Treasury and the Federal Reserve were completely wrong. And I'm right? I'm carrying on my father's tradition about being right. Because, when I made that video 4 years ago, I said buy gold. I mean, it was actually a promotion for SchiffGold. The video ends with buy gold now. And if you bought gold then 4 years ago, you're up 85% just since then. But, I don't think this bull market is over. Again, we've got a long, long way to go because the dollar has a long way to fall. I think this trend is going to go hyperbolic. I think when we go back to QE the next time and the Fed starts cutting rates, the economic data that's been coming out, technically the market sentiment looks good, but the economic fundamentals of stagflation are very strong for gold, right? Because we got last week, we got the disappointing jobs data, which was so bad. Not only did we miss estimates, but they revised down the prior 2 months by the most in 50 years. We barely create any jobs. And if you remember, if you're a regular listener of my podcast, not the Friday market wrap, which, again, I'm going to keep doing this market wrap, but I also do my podcasts. And on the Fridays where the May and June jobs numbers came out, I specifically said these numbers are going to be revised down because everybody was celebrating that the numbers came out better than expected. And I said, this is BS. They're not going to end up being better than expected. They're going to get revised down to weaker than expected. And I was 100% right. That's exactly what happened. In fact, the revisions were even bigger than what I was expecting. But these numbers may not even be right. They may revise them down again, although who knows, because Donald Trump got so mad that the numbers were so bad that he fired the head of the Bureau of Labor Statistics. He claimed the numbers were rigged to make him look bad. And now he's got a new guy, I think, but they may not even report the job numbers anymore for a while, right? Until they get it right. So maybe they need to fix it because I think Trump may be trying to hide the bad news from the public. See, Trump keeps talking about how the economy is booming. We have the hottest economy in the world. We don't. There is no economic boom. It's just a fantasy that Trump is trying to sell as reality. You know, if you look at the budget deficit for July, the month of July, it increased by 20% over last July. It's the second biggest July deficit in the history of the country. The only July where we ran a bigger deficit was 2021 when we had all the COVID stimulus. Well, we don't even have that anymore. And we got the benefit of all the tariff revenue. Yet even with the tariffs, we still had the second biggest July deficit ever. Now, if we had a booming economy, we wouldn't have booming deficits. Booming economies reduce the deficits, right? Because the government doesn't have to spend as much on unemployment or welfare, and people are earning more money. They're paying more taxes. There's more jobs. There's more profits. And so the government is in better shape. The fact that the deficits are exploding is more proof that the economy is not. In fact, if you look at a lot of other economic data, the signs of stagflation are everywhere. In fact, this week, yesterday, we got the producer price index for July spiked up 0.9, way more than expected. Year over year number, much bigger than expected. I've been saying for a while, inflation has bottomed and is headed much higher. And now we're starting to see it in the data. Of course, we're going to see bigger and bigger prints in the months ahead as a lot of the tariffs really start to get factored in to these prices. And of course, businesses are going to end up raising prices by more than the tariffs. I mean, not only are they not going to absorb the tariffs, not only the consumer is going to pay more because as the prices go up, sales volumes go down. And so now businesses are forced to generate profits on lower sales. So how do they do that? Well, they need to increase their margins. So they have even higher prices and they try to make a profit with a smaller group of customers. But it's not just the tariffs and the need to, increase margins that are going to cause prices to go up. The dollar is very weak and is going to get a lot weaker. In fact, the dollar fell again this week. And even though we got a big bounce in the stock market, again, we had new highs this week, record highs, NASDAQ, S&P 500, right? That's all a bunch of speculation. Those markets really don't tell you anything about the economy. Donald Trump and the Trump administration, they're still trying to claim that we have a great economy, and they're pointing to the stock market as an indicator. You see record high stock prices. This proves we have a great economy. Well, Donald Trump said that under Biden, we had the worst economy in the history of the country, yet we set multiple record highs in the stock market under Biden. So, the stock market means nothing, right? The stock market can go up even though the economy is lousy. And that's actually what's happening. The stock market is just a bunch of speculation. But the real markets are the foreign exchange markets, right? And the dollar keeps going down. The dollar is very close to the lows that it hit when it was collapsing following, Liberation Day. So you got a problem with the dollar. The weak dollar is going to put upward pressure on prices because, the dollar is going down. So we need more dollars to buy our imports. That's on top of the tariffs. But look at the bond market. The bond market was down on the week, meaning yields went up. The 30-year U.S. Treasury closed the week at 4.93. We are almost back at 5%. We are not far off the lows. The reason that Donald Trump initially called off the phony reciprocal tariffs was because he said the bond market was yippy. Well, I mean, it's still pretty yippy because it's about where it was back then. there hasn't been a recovery. And that's because there's real money in the bond market, right? Nobody is buying treasury bonds for, to speculate and get rich, right? It's not a meme stock. This is serious money that is selling U.S. treasuries. So the real money is getting out of dollars, getting out of treasuries, and getting into gold stocks, buying foreign stocks. That is what's going on. Foreign stocks are jamming. I have a foreign dividend payer fund that we also manage. I think it's up about 34-35% on the year. The S&P, I don't even know if it's up 10%, 9%. I mean, foreign markets are, leaving the U.S. in the dust. It's like the U.S. stock market is standing still now because money is being sucked out of the U.S. economy and it's being brought back into the rest of the world. And that trend is going to continue as the U.S. economy slips deeper into stagflation. We're going to have a weakening economy. We're going to have strengthening inflation. The government might try to hide the numbers from the public, but the reality is going to show up in the bond market, in the foreign exchange market, in the precious metals market. And so my advice continues to be get out of dollars before the dollar loses any more of its purchasing power. Convert your fiat into real money. Buy physical gold and silver. Keep buying it. I know that I talked to a lot of the reps at SchiffGold, and sales have been relatively lackluster this year, despite the fact that gold's up 25%. Not a bad year. It's doing a lot better than the stock market this year, gold. People are worried that they're buying the high. You're not buying the high. You're buying today's high, although gold was a bit higher. But a few years from now, it'll look low. You're going to have to get used to buying the highs. If you're going to keep buying gold, right, moving into the market, buying a little bit more every year, converting your savings into gold, get used to paying higher and higher prices because the dollar has one way to go, and that's down. And that means the gold price has one way to go, and that's up. That doesn't mean it goes up every day, and that doesn't mean it never declines, but the declines are going to be very short. And that's because there is big money, right? The major central banks, and maybe it's some of the not major central banks, all the central banks are de-dollarizing. And when you're de-dollarizing, how do you get out of dollars? You have to buy something with your dollars. They're buying gold, right? They don't want to necessarily buy euros. They don't want to buy yen or British pounds. I mean, what's so great about those currencies, right? They're all flawed. So the obvious choice is gold. Gold is the biggest competitor of the U.S. dollar. Even though gold doesn't pay any interest and U.S. treasuries are 4 or 5%, the markets have already spoken. The central banks don't want any more dollars. They don't care about that interest on treasuries because they know the interest is too low to compensate for what they're going to lose to inflation and dollar devaluation. Plus, they don't want to be beholden to the United States. They don't want the U.S. to have the ability to sanction them and to try to manipulate them and influence them and yield all this power. They want their sovereignty back. They want out of this, U.S. dollar hegemony where, we jump, we say jump and the rest of the world is like, how high, right? They don't want to march to the beat of our drum. And the way they exert their independence is to move away from the dollar, to back their currencies by gold and trading with one another, not in dollars, in their own currencies, in gold or something. That is the trend. And it's early. It's just getting started. So you just got to keep buying the metals. Don't worry and don't wait for a pullback because you're not going to get a pullback that's big enough to make it worth it because there's too many buyers that need to buy. These central banks have a lot of dollars to get rid of, and they keep getting more because they have these huge trade surpluses with us despite the tariffs, and they've got to do something with these dollars. And so they're going to keep buying gold. And if there's a dip, they'll buy. And now you have the institutions that want to buy. So you just got to step up to the plate and buy. And especially if you're a physical buyer, doesn't matter, right? I mean, if you're a futures or options trader, sure, you got to pay attention if that's what you're doing. But if you're buying gold and silver as a store of value, as a long-term inflation hedge, as an alternative to just holding cash in the bank or buying these low-yielding bonds, then don't matter. Just buy it now. And you know what? If you get lucky and the price goes down, well, then the next time you buy, you'll get a little more, right? When gold goes down, it's not a bad thing. It's a good thing. It's an opportunity, right? Because that means the next time you buy, you get more gold for your dollars, right? Now, chances are the next time you'll buy, you're going to get less gold because your dollar is going to buy less, but just start buying now. And again, if you really want to hit the ball out of the park, right? If you want to, swing for the fences, the gold stocks, you should also have some of those. So go over to Schiff, Europe Pacific Asset Management, talk to the guys there. I'm all in personally on these gold stocks. I mean, I've had a big position in these mining stocks for many, many years because I've been so bullish on gold that I bought these stocks. And now I think it's just starting. The trade is just starting to work out. I mean, I've had some gold stocks that have done really, really well over the last 10, 20 years, but a lot of them have been very disappointing. Well, that's all changing. It's changing now. But a lot of people can buy these stocks this late in the game, compared to when I started and still get great entry points. Because as far as the big payday is concerned, how much money I think we're going to make, we're not late at all. We're still very early. So people get, to turn back the clock and buy gold stocks rather, for the same prices that it was when gold was $1,500 an ounce. See, gold's $3,000 and $3,400 an ounce. And some of these stocks, a lot of these stocks are still lower than they were in 2011 when gold was at $1,900. Some of the big mining stocks are not that higher, much higher than they were when gold was $300 or $400, right? So this is a great time to buy those. It's a great time to buy the mining stocks. Anyway, I'm going to talk a little bit more in depth about some of the economic data points that came out during the week on my next podcast that I'm going to be doing. Maybe it'll be Sunday or Monday on SchiffRadio.com or on my YouTube channel. So if you're not a regular listener of my podcast or watching me on YouTube, make sure and tune into that because, again, I got a lot more stuff to talk about, and I'm going to keep doing, as I said, these SchiffGold Friday market wraps. I got a lot of feedback, a lot of positive feedback on the couple that I did before I left on my vacation. But now that I'm back from vacation and I'm back at work, I can keep updating everybody on Friday. So have a great week, and I'll see you again next week on the SchiffGold Friday market wrap.